This is Omega and you're watching Money Mondays. In today's video, what I want to speak to you about is how you can start a mine using your investment account. Yes, you heard it right. You can in fact start a mine. Now, of course, you don't need to go dig, so you don't have to go somewhere into the ground and dig for gold or drill for oil or whatever it is. You can in fact buy those particular commodities and then be able to sell them at a higher price than what you bought them for, thus making a profit for yourself. The difficult part is actually analyzing these assets and then deciding to buy them. And that's exactly what I'll be showing you in this video. And you guys know the drill. To show you all of this, I'm going to share with you what's on my computer screen. So let's go. Like I said in the introduction, the simplest part about this whole thing is actually buying the commodities themselves. And so the way that you're most likely going to buy these is using ETFs. So an ETF is an exchange traded fund, which is basically a basket of assets that you're buying using a single transaction or a single vehicle. And in this case, it would be an ETF that has the commodity that you're looking for. So for example, you could search for something like gold on Easy Equities, or you could search for something like rhodium and you could find that. Maybe you could search for palladium as well, and then you could find palladium. Maybe you're interested in buying platinum, and so you could find platinum right here. So that would be one way of doing it. And obviously to transact, all you would actually do is just buy the actual ETF. So I'm going to go to the absolute gold ETF right here, and then it's a very simple transaction. It's the one that you're used to if you already are using the platform. You then key in the amount that you want to maybe spend. So I'm going to say R2, and it's going to be a once-off transaction, and then I'll buy at the market open. So the market is currently closed, and that's how simple it is. That's how you'd buy your commodities. So it's very easy to actually buy. It's very easy to sell. The difficult part is obviously the analysis. So I'm going to use copper here as an example. One of the first things that you have to do is analyze the price history of the actual commodity and understand where in the commodity cycle is the commodity actually in. So we got copper here, and the global price of copper is $8,000 a ton. But here at the bottom, I'm also using an ETF to actually invest in copper. So I've got this ETF here, and you can see it mimics and tracks the price of copper. So I would spend about, say, $31 on this particular ETF to track an asset that trades at a price of $8,000. So if the price of copper, say, goes up to $10,000, then the price of the ETF will also go up with the same percentage, or roughly around about the same percentage in regards to the actual asset that it is tracking. And so I'd have to look for information. And the most important thing when it comes to commodities is supply and demand. That's the one thing that's very important. When supply is low and demand is high, generally the price of a commodity will go up. So here's a supply demand chart. It's very simple. If you've got supply rising and you've got demand dropping, then the price of the commodity will go down. But if you've got demand rising and your supply is actually low, then you'll obviously have the price of the commodity go up, because more people want it than people who actually have the commodity to sell, meaning those who are selling are going to be asking for a high price to actually sell that commodity. So the first basic place to start off with is just to type the name of the commodity and then write supply and demand, and you'll get a lot of articles, a lot of news media, a lot of research covering supply and demand of that particular commodity that you're looking at. So you can see there's an article here by Reuters. Copper Study Group expects big supply surplus in 2024, meaning potentially the price of copper is going to be going down this year. However, we then have other articles. So you can see here's one from S&P Global that says global copper demand to rise 20% by 2035 to 30 million milliliters per ton. So that's pretty cool. And we got another one here, bridging the copper supply gap, and this is also expecting the demand for copper to actually rise over time. We got one here from mining.com, the global copper market is entering an age of extremely large deficits, etc. So there's quite a lot of conflicting information, but the key thing is to decipher all this information and then create a timeline for where you think copper prices are actually going to go. Now, the key thing to remember when it comes to commodities, the way that you make money is to buy the commodity in the present day and then sell it at a higher price in the future. So whatever analysis you do, you have to basically come to the conclusion that in the future, the commodity price is going to be higher than what I'm actually looking at right now. So if the price of copper is $8,000 per ton right now, I might say, well, by 2028, I predict the price of copper is going to be maybe $12,000 $100 a ton, meaning the future price is at a discount, or the current price is at a discount to the future price. Meaning if I buy today, then yes, I'll be able to sell in the future for a higher price. Just remember, most of the time, the only way that you can make money from a commodity is to sell it at a higher price than what you paid to either mine that commodity or what you paid to actually buy that actual commodity. So just always remember that key factor. So that's the analysis that you do. Obviously, guys, if you want to learn how to do this properly, this is literally just a crash course. You can sign up for my investing mentorship program, click the link in my bio to join, or just send me a DM to sort of get even more information. And so this is how you can start off with commodities trading or commodities investing and really build a strong portfolio that will yield a lot of capital gains in the future, based of course on where the commodities cycle is. But if you buy at the right time, you stand an opportunity to actually make some good returns in the future by actually investing in commodities. Until then, guys, goodbye.